this is talking about is people are worried about they're going to take away Roth conversions. Roths are going away, all sorts of things. So pretty much, at least right now, that I think it's good that they start out. Look, these are just proposals. Okay, they propose things all the time. All right. And the proposal right now, first of all, is only affecting somebody making over $400,000 single or 450 married. Okay, so if you're under that, it's not right now, has nothing to do with you. The other thing is that they would institute some income limits 10 years down the road. So as of 12/31/2031, okay, is when they're talking about possibly limiting getting money from a traditional IRA over to a Roth IRA. So from a myth versus reality standpoint, here's the reality of what the actual proposals are that Congress is showing. So just keeping that in mind of what they're saying. And so this really hits on just the after-tax contributions, pre-tax conversions, and what folks can do. I did want to talk to you about one concept, which is if we've got this sitting over here, this is our traditional IRA, and we want to convert some of that into a Roth. Well, we have a house over here with all sorts of untapped capital, again, very lazy capital sitting over there. Well, if we do this, then that is going to create an expense right here of taxes, okay, that we have to then dial down our outflow sum to pay for. So what if we actually borrowed funds against our house to pay that liability, to pay that tax, okay? Because it's borrowed money, because it's coming into your filter over here after the tax filter, you don't have to pay income taxes on the money that you pull out using your house as collateral, also known as an equity line of credit, equity loan, okay? This is just so very simple as far as how you're manipulating and moving the PEM, just to show the effect of, I want to get some of this money over here into the yellow. So I'm going to borrow money against my house using that as collateral to pay the tax liability that would be created. But I just want to show you, let's say we've got a 62-year-old, $1 million in an IRA and $600,000 sitting in a paid off house. Okay. And they're looking at tax proposals or looking at what's going on. They want to convert it. And how would using a home equity conversion mortgage, a reverse mortgage credit line, how would that work to do that? So we've got $1 million in their IRA, and we're going to convert, let's say, $50,000 up before their RMD age. Okay. That creates $12,500 in taxes that they'd have to pay. All right, using our little handy dandy tax offset button. And then let's say we set up a line of credit, $300,000, about half of the home value, interest rate of 4.5% on whatever is borrowed, initial balance of $9,000 to cover the costs. And then this credit line is increasing at like 3.5%. Now, these are all very rules of thumb. Okay. But what you can do is over here on the PEM is you can then walk through and show them how this would work. So you've got your IRA here. You're now moving money into your Roth. You're borrowing money against the house using the home equity conversion mortgage to get all those funds over into that Roth position, reducing your required minimum distributions, reducing your tax exposure, using tax-free dollars to pay those taxes so you're not having to take it out of your lifestyle. And if you're using a reverse mortgage, you're not creating any additional payments for that either. And because of the guaranteed ability of the home equity conversion mortgage, to address one of the questions we had before, they can't call that line. Okay, it's locked in. So it's an advantage of using the home equity conversion mortgage. And if you then want to just compare what would the two positions look at 95, the house value is going to be the same. So whether you got any cash against the mortgage or not, the house is going to appreciate or depreciate the same rate. So you just look at what we did here. We've got $600,000 less in RMDs that they would be required to take out. But now we've got over $1 million extra balance. They paid over $100,000 less in taxes. They've got a higher net worth, more estate value, almost $1 million. And this is assuming taxes stay the same. If tax rates go up in the future, it's an even better idea. Okay. So again, just some of the concepts we can use, going from the very simple conceptual in the PEM to getting more into the weeds with the spending game. As you get more into the game and you get understanding how to model out those cash flow scenarios, this is a great way to help people understand and bring it to life for themselves in their own picture, their own model.